Hey everybody, welcome back to the weekly market analysis for the week ending of September 29th, 2023. We're here at the end of Q3 and there's a lot going on, and in this video I'm going to try to convince you to stay out of the markets until things become more clear. So we'll see how good I do at that. But before we jump into it today, I want to remind you to hit the like button and subscribe to the channel if you're not already. You can also follow me on Twitter at Mr. J. Thomason and follow my financial newsletter called Financially Free on befinanciallyfree.substack.com. The links to both of those are in the description of the video. And on my newsletter, you can sign up for a free 7-day trial. And if you like it, maybe keep your subscription. If not, then you can cancel it. But the first half of the newsletter is free for all to see. In the second half, where a lot more of the quantitative signals are, is reserved for paying subscribers. So as we jump into this, I mentioned, there's a lot of uncertainty out there. I think I feel less confident and less conviction about the near term than probably ever, at least in a while. So one of the things that I want to point out is, I want to go through a couple of the charts, and I'm going to try to lay out for you how I can make a bullish argument for why this is a buyable dip, or a bearish argument for why my gut tells me that this could be the beginning of a crash scenario. And so starting off looking at the S&P 500, we've got price well below the tide and the control line. And I'm going to be watching this over the next few weeks. If we don't get a material bounce to the upside, then this is going to cross probably in the next week or two, and that would be bad news bears. Obviously, the tide line can cross and then recross again, so anything could happen. But statistically, when you look back over time, you could see by those flag marks throughout, whenever there is a tide cross, it usually coincides with a pretty substantial move in either direction. Obviously, when you see the cross to the downside, it's usually a pretty sharp down move. So anyway, I'll be watching for that. But so I guess I could put it this way: my quantitative signals and my technical analysis and indicators tell me that this is a buyable dip right here. But then my gut, which is, obviously is qualitative in nature, tells me that this might actually be the beginning of a crash scenario. So let me start with the bullish argument. And so if I take a step back on the S&P 500, I've got this trend line which goes back to October, early October, and you can see that the market has touched it back in March at the SVB crisis lows, and then has also touched it now recently on this price pullback. And this is, I guess, my contention here would be that price hasn't tested this enough for this to be at threat of breakage. But then also, the fact that it hasn't been tested much means that there's no certainty of its strength as support, but it is there. And if you have to take that for what it's worth, that it's there. You also could see that, if I were to set a horizontal price level, which I should have already, but I didn't, my apologies there. If you set a horizontal line here, if we just kind of eyeball it right about there, it's not perfect because these lines are never exactly perfect, but you can see if you follow my mouse to the left, you can see resistance and then support, then breakdown, and then a little bit of resistance there, resistance, support and resistance here, resistance, support, and then now it's kind of coinciding and lining up with my ascending trend line. So I want to call that out. Just in terms of simple trend lines and trend line analysis, this looks like a good spot. As far as my tide indicator goes, if you've been watching this channel, that one of the things I like to point out is that when you are in a bullish tide, which is where the colored line is above the kind of the faded gray line, and price pulls back underneath that gray line on the opposite side of the tide line, that's usually a great spot to buy. So if we were to go back to previous previous up markets where there's bullish tide, you see it pulled underneath the tide line back in October 2020, and it did it again a couple of days in a row, wicked only in October of 2021. And then if you go back to the year 2019, you saw some pretty substantial drops in closes below the tide, or below the control line there, and then obviously with bullish tide going back pretty far. The last time we had a bullish tide cross before that was April 2016, and you could see there's a couple of dips well below the control line. Even at the beginning of 2018, we saw some prolonged price action below, which, price did make a new high, but then obviously we went into a 20% bear market correction. So anyway, and I could go even further back, but all I would say is that, this statistically is a great place to take long entries. It's a value zone, but I do want to point out that when we had a pretty substantial dip in January of 2022, that was the sign of the beginning of a bear market. That was the first dip in the eventual bear market that we saw across 2022. And I also want to point out, if I go back to where we are now, I want to point out the green triangle pointing up. And this is one of my exhaustion and reversal signals. So it's a strength-based indicator, and essentially when a market gets overbought or oversold and then starts to move the other direction, it signals the reversal on that, the reversal move. And we got that signal yesterday. Now, it's not a foolproof signal. No single signal is 100% error-free. But what I have noticed through this indicator is it's much more effective on the as marking a reversal from the bottom than it is marking a topside reversal. So you can actually see that on the S&P. So we had a couple of not really great signals. Maybe the second one of these in July was a good signal. The earlier one was not, because we made a higher high. In June, it provided a signal before a pullback. It basically marked the top back in August 2022. I don't know why that. Oh yeah, there we go. Never mind. Sorry, but you could see, like, on the upside, it's not a really great signal in a lot of cases. Sometimes it marks tops, but sometimes it doesn't. So I think that's important, especially in a melt-up scenario. Like, you get this signal on the upside quite a bit. So obviously the late 2019 and early 2020 melt-up in the equity market, you got a lot of those signals. So it's not as good on the upside, or like when you're marking reversals to the downside, I should say, but it's actually exceptionally good at getting bottom ticks. So you can see right there, we've got that signal showing. We got that signal in October, right around the times of those lows where I marked that trend line. It was at the bottom of the end of January before there was a bounce. Now this one obviously didn't lead to new highs or any sort of really big substantial rise higher in prices, but it was the beginning of a bounce. Where it doesn't work super well is in a crash scenario, so you can actually see it happen a couple of times before the eventual bottom, but that last one was indeed the reversal, the bottom signal. Bottom signal here in August 2019, bottom signal here in December 2018, as well as on one of the bounces in price during that bear market, bottom signal in February 2018, and if I just keep going back, you find that the green triangle pointing up is actually a really solid signal. So this is telling me that my reversal signal, which is a relatively high degree of accuracy, could be signaling that price is about to move back to the upside. Right, so there's that. And then I could also go to my sentiment survey data, in which the amount of bearish sentiment is at extreme levels. I would like to have seen this up in the bearish one, which is the third set of bars. I would like to have seen that go up to the 90th percentile, and then the spread and bullish indicators go down to the 10th percentile or lower. But even so, it's getting pretty stretched, and it's getting really, really bearish. I mean, if you look at it on the time series, you can see on the right side that we have gone to levels which are more than a standard deviation below the average as it relates to the spread between bulls and bears. And if you want to go so far as to say, like, you could draw a trend line from these bottoms, this would be a spot where you could mark one of those kinds of trend lines. So I do want to point that out as well. And then, of course, if you go to my tax signal plot, which I offer this information to my paid subscribers to my newsletter, but what I want to point out to you particularly is the actually I need to refresh this. I'm sorry, let me refresh it really quick. Is I want to point out the concentration of assets on the bottom left quadrant, which is showing low relative strength, as well as a -2, in this case, a lot of these -2 sigma standard deviation away from the average price over the last year, or price changes over the last year. And all that is to say, again, like this, so much concentration in the lower left quadrant tells me that this is, as well as, the dollar is, wait, where'd the dollar go? I missed the dollar. Oh, the dollar is up in the far right side, which is way overbought and outperforming. And just that also suggests to me that we're seeing some price capitulation. And so I have those kinds of indicators that suggest to me that this is a bottom. What isn't really working, and I don't have the updated charts, so I'm not going to show you right now, but my positioning data that I look at actually got more bullish. So it's weird to say that even on this price action, a lot of people bought the dip. So that's the one thing, as far as like my research process, that isn't lining up so well. So I want to point that out. And to me, like, the other thing too, like, I was trying to think about this from a different perspective than normal. So what's been going on is basically for all of 2023, people came into the year expecting recession, and positioning has been relatively low. And then ever since the end of the SVB crisis, people have been looking for the market to roll over and come off. And then it not only appreciated, but it took off in the summer, like at the late spring and early summer and into July, the end of July, just roared to the upside. I mean, if you think about it, just from the SVB crisis lows to the highs on the S&P, the index is up 17%. So, and then obviously if you go from the start of the year, it's almost 18%, and then if you go from the October lows, it's almost 25% up. And so the markets have really come up, and what I've been thinking about actually the last few days is this the spot where people have been waiting to buy the dip? And I don't know, my positioning data kind of tells me that people are trying to buy the dip. And actually, like a lot of people on a lot of the financial news shows are talking about, oh, price needs to come back so that we can buy the dip, right? And so people have been saying, oh, it's too expensive, too expensive, too expensive, too expensive. And then finally price is pulling back, and it feels like this could be the spot where everyone's like, okay, we've seen, what's the decline from the top? We saw almost a 9% decline. So it's like, oh, the markets are almost 9% down. Now I can actually buy into this dip. And so what has me worried about that is if that's what everyone is thinking, then either the market is going to take off before everyone buys the dip, or the market is going to just pierce right through the level that everybody wants to buy the dip at. And this is where I'm going to shift into a little bit of my bearish argument here. Again, the positioning data is actually showing that people largely are buying this week, which is problematic because what I was actually looking for over the last few days was I wanted to see flows data super negative, which it's not really negative. It was actually more positive in the last few weeks. I wanted to see the bulls bears sentiment go very bearish, which it did. That was a check mark in favor of finding a durable bottom. And then I wanted to see the positioning data line up, and the positioning data did not line up. And the thing that I want to point out is a couple other things too that actually, I'm sorry, I gotta pull back for a second. This is another reason why I was thinking that we might be at a durable bottom, because when you look at the stocks above the 50-day moving average, you might be able to see, like, I have a red line at 90 and a green line at 10, and that's because over the course of this of the time series, durable bottoms are often, or I guess bear market rallies happen when this gets to when it gets to the 10 line or below the 10 line. So I've actually been watching this for a while to see if this would get below the 10 line, and I would actually lean in. So yesterday it actually climbed back up, but then today it sort of dipped back down. So I'm wondering if we have to go down below this 10 line. So it's like I can look at this as being bullish or bearish, because if you look back during the period of time when the SVB crisis happened, which was right here in March, we didn't get below the 10 level, but my reversal indicator worked for this one, and it was at around the same level. And so there's a part of me that wants to say, like, okay, what do I need to be, am I just waiting and getting too cute for it to hit exactly 10 before I actually take the long side? But then the bearish side of me says, well, no, like, if this hasn't gone down all the way to 10, then it in theory could continue to drop, and all the momentum is to the downside. And then add to that the fact that the stocks above their 200-day moving average is well below 50, but it's not to levels associated with reversals, So I think that gives me caution. So I wanted to point that out as well. Another thing on the bullish side is some of my underlying indicators, like the high beta to low beta ratio, looks like it's going to reverse to the upside. And as long as the price stays above the control line, we won't get a cross, which is usually a good sign. And then also, but then on the bearish side, JNK slash 1 to 3 year treasuries looks like, while it might be reversing, it looks like it's going to get a cross, a bearish cross next week, and then that's going to trip some of my underlying signals to suggest that the price is going to be potentially neutral or bearish in the near term outlook, and so I'm looking at that too, right? And then you have the VIX, which ended up closing positive on the day, but is definitely down from the levels that it was at. This could spike higher. I don't know. And then another thing that I wanted to point out is the credit spreads, which credit spreads are usually pretty attached to what happens with the VIX, right? This is to the upside. I mean, I feel like I just wrote about this last week that, the credit spreads are not really that concerning, and yet here they are, like, going up, and that's a little concerning. Another thing I want to point out is the yield curve. This week we confirmed a bullish tide cross, and I've done a lot of work on this to look at the time series of this. So when you have an inversion in the yield curve, and then you follow that inversion with a bullish tide cross, then you're pretty much 6 months or less away from a recession, and on an average interval that's about 3.5 months, and the median's about 3.5 months to a recession beginning, and this is the beginning of the recession according to the NBER, and usually the time to buy bonds is within a month of this taking place, and then of course in most cases when the recession is coming, usually the market peaks 1 to 2 months before the start of those recessions, and of course there are exceptions to that, but that is what happens quite a bit, and so that's something I want to be concerned about, because 3 months from now, that's the end of December. So if the recession started 3 months from now and the market peaks a month or two ahead of that, then we're looking at a peak in like October or November. And then of course you could push that out a little bit depending on how far it goes, right? So this is not a good sign, because when it's not the inversion that's the worrisome part. It's when it steepens again that's the worrisome part. And so that's a big deal. Bond market volatility has jumped up in recent days as well. So that's obviously something that you want to watch. So anyway, like I all of these signals, like there's enough bullish and bearish signals to give me enough pause that I'm actually neutral in the markets right now. And I'm willing to stay neutral until things clear up. And so for me, it's going to take, I'm sorry, there was one other signal I wanted to show you, and that was the candle signal that I have here, or the overlay that changes the candles different colors. As long as it's red, it signals that it's not safe to be long in the market. But also because making money on the short side is hard, especially in the equity indices, because there's a lot of upward drift in the in equities. It's you have to like pick your spots and be really quick out, or in and then out in these. So it's very, very risky, because you get your face ripped off if you're short in this market. And obviously people who have been short in the market since the beginning of the year, they know exactly what I'm talking about. So I feel like all of these things are conflicting signals, and so it's just much better to be out of the market right now. It's safer to be out of the market right now if you can be, or more defensive in nature. Just a couple other things I wanted to look at. The yields are giving a couple of reversal signals, or potential reversal signals. So we'll see if we get some relief in the bond market and in the yields. And if the yields come off, that'll be net positive for equities. Same thing on the dollar. Got a reversal signal on the dollar. So if the dollar comes off a little bit, then that'll be a relief for equities. And then let me check out gold. So I'm going to be so annoying about this on Twitter and probably in my videos, because if there's one thing that I've been loud about, like just go check out my Twitter, because back here in April, when price was above $2,000 and everyone was screaming about new all-time highs coming inevitably this year. Go back and look. Right around here, I said, no, gold will not make a new all-time high in 2023. And I also said that it was more likely that gold would go to 1,800 than it would make new all-time highs. And I know we're not at 1,800 yet, but come on. Like we closed today 1848 and 82 cents. And the decline over the last few days has been gnarly. So is gold oversold? Yeah, probably. But and could it bounce? Sure, but gold has also bounced a couple of times and still made lower lows. And we got the tide cross. And so the last time we got a tide cross to the downside, gold fell. Let's look at it. So the tide cross is right about here. Gold ended up falling another 11% by the time that was over. And so, and that's just the last time. And, I have a whole big thread that I've been posting and reposting recently on Twitter. If you want to know why why I believe gold is not going to go up to new all-time highs until next year on the other side of recession, then you can check that out. Crude oil looks like it actually might be finally getting a pullback. I called a top here on Tuesday last week, and it proved not to be the top because we made a newer high, but now we got some full-on reversal signals after ginormous move to the upside on Wednesday, and then we had something like a daily reversal yesterday, and then a similar kind of intraday reversal on crude oil today. So it's not to say that crude is going to has to come off by a lot, but it does, I think, have to come off some in order to get some new buyers into the market. And so I don't have the positioning data updated right now, so I'll be interested in looking into that over the next few days. And I think that's where I'm going to stop for today. Yeah, Bitcoin, not really impressive right now. Still having trouble getting back above its tide line and above its control line. It's like every time you get a good bit of price action in Bitcoin, it just ends up leaving you disappointed. And until the liquidity inflects positively in any material way, I can't imagine that Bitcoin is going to do very well in the near term. So we'll see what happens. I'll reserve judgment on that. But like I said, I'm generally flat in the market, waiting for clarity, and I think that that's a good position to be in. So we'll stop there, and so I hope you guys have a great weekend. Be safe, and I'll see you guys next time.